how to clean up one's investment portfolio and meet financial goals in turn. With the advent of financial planners and online financial portals, investment and financial planning process for consumers has become fairly simpler. However, despite the rising popularity of financial planners and these portals and them defogging the process, many investors still end up goofing up on their investment portfolio. What would be your suggestion, Feroze, if I can bring you in here, to those investors in terms of cleaning up their investment portfolio?
Abhishek, I think over a period when an investor is buying products from different service providers, you end up creating a large portfolio without actually having relevance to each individual instrument which constitutes and comes together to become a portfolio. So cleansing your portfolio and making it more sharper, more accurate is critical, and this is an outcome of a good review mechanism. So I think cleaning up is critical, point one, because as you progress, you're going to have things which are not going to be remaining contemporary in your portfolio. So there is a need to clean up. That's point one I'm making. How do you go about cleaning up is something which could be a 3, 4, 5-step process. First is, to my mind, revalidate your goals, because as you progress in life, your goals can change, or some of the goals can come closer than they were when you last looked at those. So please revisit your goals on an annual frequency and see what are your top 3 goals in life, and see if there are some changes to it. For example, if you wish to buy a house 5 years from now, and after 1 year, that is 4 years before you wish to buy it, if you realize that the price of the house is deteriorated by 20%, then you will have to allocate the money which was set aside for the property or the asset purchase to something else. So it's important to revisit your goals. I think that's the first step, and marry it with the current portfolio and try and see if there is synergy between the goals and your current portfolio. That's step one.
So, Feroze, you've always brought this out, in our past conversations, that diversification is quintessential. However, investors at times invest in a wrong or unwanted fund in a bid to diversify. Now, where does one potentially go wrong, and how important is it to bring about the required rectifications in the portfolio?
I think Abhishek, what ends up happening is that you may have more schemes than required. Especially when we've analyzed several equity mutual fund portfolios, we see that people have more than 8, 10, 15 schemes in their equity fund portfolios, and all of them focused on the same geographical destination from an investment standpoint, which is India. So you might optically think that you have diversified to 15 different schemes, but all of them are converging it back into the same capital market, which is Indian equity. So that's only optical diversification. It's not actual diversification. So statistically it's proven that 7 schemes are more than enough to create a portfolio on the equity mutual fund side. If you have more than 7, replace one of them and convert your portfolio to less than 7 equity schemes, because even if you have a few crores to invest, I think 7 schemes should be good enough. Don't go overboard, because if you did so, the reason why you pay a fee which is to generate more return than the market will not happen, because if you buy the entire market, you can't beat the market. So please make sure that you don't over diversify. I think the second step should be to chalk out the portion of the portfolio which you need, and actually identify which tail which needs to be trimmed. And especially when you have schemes where you have very little money, 2, 3, 4% of your money, trim that tail and make sure that you're focusing on the core rather than the peripheral portion of your portfolio.
So Feroze, what you're telling us is we end up duplicating rather than diversifying. So diversification is crucial, but we need to keep in mind the various types of diversification that one needs to have in the portfolio. Now, moving on, Feroze, if you could also, if you could guide our viewers in a situation wherein your portfolio is going off course, that is, it is deviating from the pre-decided objective in terms of being in conjunction with your financial goals.
Yes, I think after you've done step 1 and step 2, the chronological next step should be to restructure your portfolio. Restructure your portfolio after the inference which you would have derived from the step 1 and 2. You have to restructure it, and to do that you have to check whether the asset allocation is correct. Step 1, do you have adequate equity and debt mix, and is the mix correct as per your goals? That's one check you have to do. Check 2, which you have to do in step 3, is to see what are the vehicles you wish to use, because as you progress you will learn a lot, and you will know what are the products which are worth forming a part of one's portfolio, which are not. So use your judgment derived out of experience of the last few years to trim that portion. For example, when it comes to equity investing, we realized that portfolio management services, which is a prominently sold product, PMS, were not good products, because they were taking significantly more risk to generate the same returns. So step 3 is restructure your portfolio, check your asset allocation. Point 1, check your product selection. Do you have to ban some products from your portfolio after the experience you've had in the recent years? So I think these two will help you restructure it and get back to the asset allocation of 60-65 in equity. Now also let me recommend 60-65 in equity for a client with 5-year time frames should be a fair allocation favoring equity, especially before the general elections.